Good morning, traders. This is your Forex market commentary brought to you by Real ECN. Today commentary, we will touch base on the euro-dollar market. A bearish bias continues to be the prevailing theme for the single currency as this week's trading session price action indicated that the euro-dollar pair is struggling to stay above its multi-month support floor. On the fundamental front, aggressive easing threat by the ECB will continue to trap the euro in this bearish sentiment. I hope that this commentary will prove to be insightful for our traders in formulating a successful trading strategy. So first in line with this discussion, we will touch base on the euro-dollar market on the technical front. Here we have the euro-dollar pair price action on the 30 minutes time interval. The technical narrative for the euro-dollar market this week has been tainted with congestive trade or breakout lacking a follow-through momentum. During Tuesday trading session, the euro-dollar pair dipped below the 200-day simple moving average on a soft German PPI month-on-month print coming in below expectation. It is indicative that inflation has continued to remain stubbornly sluggish. Yesterday trading session, however, when both the German and Eurozone PMI report was released, the market appeared to exhibit muted response. For instance, a disappointing German manufacturing PMI print is balanced out by an upbeat service report and likewise can be said with the Eurozone PMI print. However, the pair intraday major decline was triggered by a disappointing print in both the US initial jobless claim as well as existing home sale print, which failed to beat expectation. This news feed should prove to trigger a brief euro rally. However, the opposite price action has occurred, and despite a print reading dipping below forecast, it grew to beat previous reading, and this was good enough for the market to sell the euro in favor of the dollar. In accordance to the SSI, which is commonly known as the Speculative Sentiment Index, net retail traders' long euro-dollar interest has risen significantly, where at the same time short interest has fallen to record low. Currently, the ratio between short to long position taking up by retail traders sit at 1.5 to 1. Since long euro-dollar interest is gaining traction, analysts who are suggesting taking the contrarian standpoint to this crowd sentiment is in favor of further euro weakness down the line. As long as the pair failed to sustain trading momentum above the 1.3820 level, the pair continued to be subjected to bearish bias. On a larger time scale, the euro-dollar intramonth price action indicated that the pair has broken the support floor of the rising wedge formation, which started from September of 2014. Thus, this exposed the pair to the next tier of support floor set at 76.4% Fibonacci retracement of 1.3598 level. Aligning the bearish euro fundamental with its technical breakdown, analysts are suggesting entering into short position with targets set at the 76.5% retracement. Analysis of a collection of technical indicators on the 30 minutes time interval on the euro-dollar market suggests a temporary bearish market sentiment and recommend long position on the greenback. The hourly chart showed that the single currency opened today's Sydney trading session 2 pips below its established short-term Fibonacci support at 1.3654, while the Fibonacci resistance is set at 1.3658. This week, euro correction has forced the euro-dollar cross to break below the 200-day simple moving average and continue to trade below the 200 days. The long-term outlook on the single currency has been downgraded to bearish if the trend line continued to trade below the 200 days. This trend action holds great significance as 200-day simple moving average contain more or less a 1 year's worth of trading data and then forecast long-term market sentiment. This bearish long-term outlook on the euro-dollar pair is also shared by its short-term moving average counterpart, as the euro-dollar pair opened today's Sydney trading session in line with the 20 but below the 5 and 10 and 30-day simple moving average. Collectively, this is indicative of a sell recommendation on the technical front. The CCI signaled that the trend line is currently trapped in a congestive trading range, while the RSI validate that the bearish bias continues to hold strong on the euro-dollar. Now moving along to the fundamental front on the euro-dollar market. Much of the U.S. risk event this week has very little influence over the Federal Reserve monetary policy mandate. However, the main attributing factor that allowed the dollar to rebound against the single currency is the rise in Treasury yield. However, as long as the price action on U.S. Treasury yield continue to remain trapped within a tight congested boundary, the greenback has very little momentum for a major breakout and a follow-through momentum. The US labor market is showing signs of improvement. From the labor market with initial jobless claim, which is ticking higher, but within the range of its forecast, has fallen to a 7-year low. Even existing home sales has improved compared to the previous reading. Nevertheless, the FOMC is still not convinced that the recovery is robust enough to sustain itself without the Fed's accommodative assistance. Across the Atlantic in the Eurozone, one development that can become a concern for any long-term Euro fundamental is the Eurozone current account. The March report indicated that the Eurozone current account surplus has fallen from 21.8 billion down to 18.8 billion. If current account continue to show consecutive signs of weakness, this can undermine the Euro bullish bias. The slowdown in both Eurozone and German manufacturing PMI can be the factor that the ECB would argue for further easing policy. The price action began to decline after peaking out north of the 1.3900 level, indicated that the market are beginning to price in the possible ECB easing tools, which included reducing the Eurozone benchmark rate, introducing negative deposit rate, new LTRO program to encourage lending velocity. The next ECB meeting will be held in June, and if policymakers are not aggressive enough, or not as aggressive as they appear to be, it could be the very catalyst for a Euro rebound. Thank you everybody for listening and have a good weekend.